Well, welcome everyone. We'll give everybody a few more minutes to get in. We have a number of people joining right now, so we'll give them a couple more minutes to join and then we'll get started. All right. Well, thank you for joining us today. I want to welcome you to our economic update call. I would let you know that we are recording this call, so if you're uncomfortable with the recording format, please feel free to drop off. We will be providing the recording later, so if you'd like to pick up a copy, Karen can get that to you after the call. Also, many of you receive our economic deck that we do each quarter. That's a longer deck. It's about 60 pages. If you don't receive that and would like to get a copy, please feel free to contact me or Karen. We'll get you a copy of that. We'll also have slides following our talk today. I will be talking without slides, but we'll send you a short deck that summarizes some of the material that we're covering. So wanted to take a moment also and thank you for your ongoing relationship with Cornerstone. We certainly appreciate the opportunity to partner with you, and it's a pleasure to be able to talk to you today about what's happening in the markets and in the economy. So with that, I'll jump in. I wanted to kind of pose a couple of questions as we get started that I think a lot of folks are asking. One of the questions we get frequently is, are we in a recession now? Another question that we're getting a lot of the time is, what's happening with inflation? Is it going to get worse? How do we need to think about that? And then what do we think is going to happen in the market next year? And of course, I wish I had a perfect crystal ball and could tell you exactly what's going to happen in the market next year, but we will give you some thoughts about where we think markets in the economy are going. I'll also close out our talk today with a rapid fire round of some other questions we've been receiving that hopefully will answer maybe some of the ones that you have outstanding. Now, as we get started, it's important to understand when we think about markets in the economy, to think about where we've been, to understand where we are and where we're going. So where have we been? Well, it's a unique environment because we had a very long expansion. In fact, the longest post-World War II expansion on record going into COVID at the end of 2019 and the beginning of 2020. And of course, we're all too familiar, I would say at this point, with what happened with COVID. And as a result of COVID, governments around the world shut down their economies and basically created an artificial temporary recession. To deal with that, central banks around the world flooded economies with money. So they took a very aggressive monetary stance and made a lot of liquidity available around the world. Coupled with that, we had fiscal responses by most governments around the world to address the challenges brought about by the COVID containment measures that governments put in place. And so we had a very short but steep market decline. And we also had a very short recession. In fact, one of the shortest recessions on record here in the U.S., just a couple of months. And so that recession officially ended in June of 2020, and we began a new expansion. Now, that expansion, much like the COVID recession, was very sharp and very short, and it's been ongoing since that date in June. And as we think about that, that's kind of the key to understanding where we are today. What brought about that expansion was a combination of monetary and fiscal policy. So remember that monetary policy is when the central bank does things that stimulate the economy. And so what things can they do? Well, they can lower interest rates and they can take unconventional means called quantitative easing, where they're basically buying treasury debt and injecting cash into the economy. And so we saw a significant amount of those two things happening in 2020. Also, as we got later into 2020 and early into 2021, U.S. fiscal policy, that's the government taxing or spending, had a huge impact on the U.S. economy. The government basically came through with a number of different policies to further stimulate the economy. They offered PPP and other direct transfer payments to individuals that basically injected additional liquidity in the economy. And that led to a very red hot economy in late 2020 and early 2021, and actually as we moved into 2022. Now, that kind of brings us briefly up to current. And I want to say a couple things about that period of time, because I think it's really important that we understand that those things were not necessarily bad or good. They were simply measures that government entities could take to offset the challenge of a pandemic that many of us have not seen, something like that really at any time in our lives. The last time that there was a global pandemic of that magnitude could arguably have been in the 1919 time or 1920 with the Spanish flu epidemic. There were a few others in the 60s, but they were not nearly as significant. And more recent pandemics have not been global in scope. And so addressing this was significant, and it continues to be a challenge. And so we need to understand that COVID, while here in the U.S. it's largely past, it's still having an impact around the world, and it's still impacting supply chains today. And so the first thing we need to realize as we think about what happened in 2021 and 22 is that we had a COVID containment component that snarled supply chains around the world. And that snarling effect was not just logistical in nature, but also it caused challenges actually in manufacturing. And so we had both pieces. And if you had asked Cornerstone in, say, 2020 or 2021, how inflationary we thought that was going to be, we would have said, well, we don't really think it's going to be terribly inflationary. So in that sense, we were wrong. We did not expect inflation to get as hot as it's gotten. And I want to kind of give you the rationale behind what that change is and why we've seen an adjustment to CPI and the PCE here in the U.S. So as we think back to those times, the challenge was that we had a spike, if you will, in supply chain issues. And so logistics around the world were brought to a halt because of different COVID containment measures in different countries. And so it seemed as though most of those issues would be resolved in the course of 12 to 18 months. And we're already seeing a lot of that, actually, that the supply chains themselves have in many ways been dealt with at the logistical level, meaning that once again, goods are flowing around the world. The challenge, however, is that that has not dealt with all of the manufacturing issues, and particularly with manufacturing issues related to specific products. And so I think that when we think about that, we need to understand that that was the first component that's leading to some of the inflation we're seeing today. And a good example of this, you may have seen in the news recently, was Apple shifting part of its supply chain for iPhones from China to India because of COVID containment issues still ongoing in China. And those are manufacturing related, not shipping or logistics related. So that would just be an example of what I'm talking about that would have led us to say, hey, this may be more short-term in nature when we think of the inflationary impact, but it has lengthened to this point. The second component that's led to a bit of inflationary pressure here in the U.S. Has been the fact that as people have come out of COVID, the excess dollars that flowed into the system that were initially captured in excess savings are now being spent. And so there's a lot of demand for goods that may or may not be as available as we would like them to be. And so that tends to push up the price of those goods. So we can think about the classic definition of inflation as too many dollars chasing too few goods. And so we're definitely seeing that as we transition into 2022. And we're seeing it particularly not only on the goods side, which we saw in mid to late 2021, but now we're seeing it on the services side as people are comfortable getting out of their homes and beginning to travel. The demand for travel and related accommodations, things like rental cars that were affected early on are now coming back with a vengeance. And so there's a lot of demand, but other pieces of the pie have not caught up yet. So one example that we would use in that area is simply the issue of rental cars. Most rental fleets replenish every year. They were unable to get all of the cars they normally buy. So now you have demand spikes in particular areas of the country, and major car rental companies don't have as many cars as they normally do. So the price of cars is significantly higher in certain parts of the country than you would normally see. For example, I was traveling recently and I paid almost $1,500 for a car for 3 days in Phoenix. And then just a couple days later, we were traveling in another location and the car was less than normal, less than $60 a day. So you see very unusual things, and a lot of that is related still to a adjustment from those initial supply chain shortages. So understanding how that's beginning to affect inflation and has led to some of the spikes that we've seen is an important component. The last thing I wanted to mention is that there was also some artificial scarcity. What do I mean by that? Well, in late 2020 and early 2021, we had artificial scarcity in things like lumber. So you saw lumber prices skyrocket because there was a significant demand for additional housing. That demand's been building actually for 10 or 11 years post 2008. But as that demand grew because of people moving out of the cities during COVID, we saw a temporary spike in the price of lumber because, again, you couldn't transport lumber very easily from Canada to the U.S. And so it appeared that there was actually a shortage of lumber when in reality there wasn't. And you've seen a complete collapse in the price of lumber over the last 12 months. So those are some examples of things that are affecting that inflationary picture that we had a couple of years ago. So if we fast forward to today, where does that bring us out and what do we see? Well, as many of you know, Cornerstone has a 5-factor model that we use to evaluate the overall economy. And there's certainly many more factors than that, but that 5-factor model gives us a good view of where we are currently. So where are those 5 factors and how do we see them today? Well, the first factor, as I mentioned, is monetary policy. And so we saw this massive expansion in monetary policy. And then as we entered 2022 and inflation began to pick up, central banks around the world, and particularly the Federal Reserve here in America, realized that inflation was taking off and they needed to react quickly. And so what looked like it was going to be a relatively slow pace of Fed rate hikes has significantly expanded, and the Fed has aggressively engaged and begun to hike interest rates. At this point, we've seen multiple hikes throughout the year, and we're actually expecting 2 more hikes as we close out the year. The Fed is meeting the first here of November, and we expect a 75 basis point rate hike at that time. They'll meet again in December. Right now, the odds still favor a 50 basis point hike, but I think it's actually quite likely that we could get a 75 basis point hike in November as well. So the Fed is reacting very aggressively in tightening monetary policy to push down inflation. Now, another piece of that we need to understand is that I mentioned earlier that the Fed engaged in quantitative easing to support the economy during COVID. They're now retracting, so they're doing quantitative tightening. Well, what does that look like? Well, remember, the Fed bought bonds in the public market to inject cash into the market so that people would have more cash to spend. The flip side of that is now true. They're selling those bonds back into the market and pulling cash out of the market. Now, one little side note on this quantitative tightening and quantitative easing component. Sometimes people ask me about, well, Bryan, how does this affect overall U.S. debt, and is that a good thing or a bad thing? The thing to remember is that the Fed, post-2008, bought about $4 trillion worth of bonds. So they historically held, up until 2008, they normally held $50 to $100 billion on their balance sheet as a bank in terms of just excess reserves of bonds. Post 2008, that number grew to $4 to $4.5 trillion. After 2020, the number doubled to over $8.5, almost $9 trillion. So huge expansion in the Fed's balance sheet. That's a lot of money to inject into the economy. Now, over time, a lot of that money actually goes back on deposit with the Fed. It's held by banks. So it's not necessarily immediately inflationary, but it does add to liquidity in the system. So in the last 3 or 4 months, the Fed has begun to significantly limit that liquidity and has been moving the other direction by buying, basically allowing bonds to mature off their balance sheet and not rebuying them. And so this actually has the impact of tightening monetary policy further on top of the interest rates. So what we've seen is over the course of the last 9 months, a massive shift by the Fed to quickly raise interest rates and begin tightening policy. That's very, very important because one of the things that we want you to take away from this call is to understand that the Fed is aggressively trying to combat inflation. Excuse me. They may even be combating more inflation than we actually have to deal with, and I'll talk about that more in a moment. But they're aggressively combating inflation by raising interest rates and shrinking their balance sheet. So monetary policy has moved from very, very accommodative and positive for economic growth to tight and challenging to economic growth. So when the Fed does this, when they raise rates and shrink their balance sheet, effectively what they're doing is they're impacting demand. So you think about the easiest way to see this is in the housing market. As rates go up, the cost of a mortgage goes up, and therefore the demand for housing goes down. People are less likely to sell because people can't buy as much house as they could just a few months ago. To kind of put this in perspective, the best estimate that I have for you is that a family that was able to afford a $500,000 house at the beginning of the year, the change in interest rates to this point would suggest that that same house effectively, the cost of a $350,000 house would be approximately commensurate to the $500,000 house at the beginning of the year. So if you're selling into that market, the tendency you have is to not sell, or you're going to have to lower your price a bit to attract buyers. So we still see a hot housing market, but nothing like it was just a few months ago, and it's rapidly calming down. So that first point is monetary policy and the way it's impacting the economy today. The second point that we want to talk about is fiscal policy. So I mentioned that fiscal policy was very accommodative as well. We saw tax cuts, we saw PPP, we saw multiple acts put together by both houses of Congress and the president to stimulate the consumer. And so, of course, all of that now has stopped, and we're actually seeing fiscal policy no longer be as accommodative as it once was. It's actually slowed down. And so the fiscal drive behind the economy is no longer prevalent, and we're seeing a slowdown in that respect. So that will actually help address some of the inflationary policy, the inflationary problem that we have. However, I do want to mention, because this was a big issue that a lot of people ask about, inflation really did not seem to be getting out of hand until the last couple of big fiscal policy actions. And so fiscal policy has a more dramatic and quicker impact in many ways than monetary policy. So sometimes monetary policy takes longer to develop. Fiscal policy tends to act quickly, and then it actually fades from the economy quickly. And that's important to remember. So we saw very, very fast moving fiscal stimulus in 2020 and 2021. That's already fading, and we expect it to continue to fade. So that brings me then to exactly where we are now with the global economy. So that's our third factor is, well, where is the global economy and how's that affecting the U.S.? Well, unfortunately, because of the geopolitical challenges and the war in Ukraine, that war actually exacerbated the inflationary pressure because it further impacted supply chains in key areas, particularly the area of wheat, oil, and some other commodities that are particularly challenging to get. We might think of things like rare earths or lithium, those types of things. So the challenge is that on top of what was already a mildly inflationary environment, we ended up with a war in a key part of the world that is affecting major commodity prices, oil and wheat. And so that further pushed up some of the inflationary pressure, causing a significant reaction not only by the Fed, but it's pressured other central banks, particularly the European Central Bank and the Bank of England, because they are experiencing significant inflation. In fact, Britain's inflation is the highest in over 50 years, and they're responding accordingly with higher rates. You may have heard recently that Britain elected a new prime minister just before the Queen passed away. That prime minister has already been forced to resign because her policies were actually considered to be so stimulative that it would actually exacerbate inflation rather than potentially address inflation. There's a lot to be said about that. I don't have time to get into it. But the important thing to understand is that it was destabilizing, and it further challenged markets in Britain, in Europe, and around the world. The recent change to a new prime minister, I think, will address some of that. We've already seen improvement in the British markets. And so that's actually a really positive element for interest rates around the world, because things have stabilized a bit. That could have gotten out of control, but it's a geopolitical risk that we don't have to be as concerned about at the moment. But the risk we do still have to be concerned about is the war in Ukraine. And so that continues to be a challenge. It continues to be inflationary in nature, and it is pressuring central banks to react more aggressively, perhaps, than they would have wanted. Now, as we think about those factors, what is that saying about the U.S. economy, and what is it saying about markets? Well, the thing we have to understand is that the U.S. economy remains very strong. Unemployment has dropped to 3.5%. Manufacturing and the service sector are both in an expansionary phase. And so we don't believe that we're in a recession at the moment. However, whenever the Fed raises rates aggressively to try to tamp down demand, the probability of recession goes up. And so we're facing the fact that it's very likely that the U.S. does slip into at least a shallow recession in 2023. From Cornerstone's perspective, we think it's quite likely that we slide into that recession mid-year next year, and that it is likely to be shallow. And so as we think about that, that has implications for the market that we'll get to in a moment. But at the moment, it's important to note that currently the U.S. is still seeing expansionary growth across the economy. Now, you might say, well, Bryan, we had back-to-back quarters of negative GDP growth in the first and second quarter. How do you deal with that? Well, that was real GDP growth. Nominal GDP growth, which includes the impact of inflation, was actually still very positive. So we did see a brief retracement there from a real perspective, but overall, the U.S. is still growing, and we expect that growth to continue. The other element that's important to note there is that, remember that there was some level of demand that was pent up because people saved money during COVID as they got transfer payments. They weren't able to spend at the same level that they may have normally spent at. And post-COVID, they've spent down those savings. So savings rates have dropped from almost 20% back to below 5% over the last 9 to 12 months. So we've seen significant expansion in spending. So to bring us up to current U.S. economy, still healthy, still spending. We have constraints in various areas, as we've outlined. And so then that causes us to look forward and say, well, where do we think things are going, and how is this impacting the market? Well, where we think we're going, as I was just saying, is that the global situation is very challenging. Arguably, many European countries are already on the edge of recession, if not in recession. Britain is certainly on the edge of recession, if not already in recession. And so global demand is weakening. China is struggling, in particular due to COVID containment measures that they're still implementing. And so Chinese growth has slowed. So when we look around the world, most major economies around the world have relatively high inflation and extremely slow, if not negative growth. So this is a problem for the U.S. economy because we don't exist in a vacuum. The other piece to this that I haven't yet mentioned is because of the rise in interest rates, the U.S. dollar has risen sharply as well. The dollar is at levels that we haven't seen since the late 90s. Now, this poses a challenge then for U.S. corporations because as they sell overseas, our goods are more expensive. The flip side of that is that as U.S. consumers, it makes foreign goods cheaper, but we're having a problem still importing some of those foreign goods. So that can actually be somewhat inflationary in the short term, even though a strong dollar in and of itself is not necessarily an inflationary problem. So it does, though, pose pressure for the economy. So when we factor in those first three factors, all of them are fairly negative and point towards a recession in 2022. And that brings me around to the market. So everyone is aware, and probably that's the big reason that you're on the call today. Hey, the market is down. It's the worst market we've experienced in some time. How do we feel about that? What's Cornerstone doing about it? What do we need to do, if anything? And so let's talk for a moment about the market. And here I want to begin to draw a parallel to leave you with as we wrap up the call over the next 10 to 15 minutes. The parallel is that in many ways, we believe this market and economy are similar to 2000 to 2002. Now, let me draw you a few parallels to begin to get you to see that kind of comparison between both the market in that time period and the economy in that time period. So at that time, the U.S. economy was coming off a very long expansion. At that time, it was the longest post-World War II expansion on record. Stocks were quite high, and particularly high growth stocks had been arguably overvalued for several years. We also had a Fed that was raising interest rates into the year 2000. So similarities to today, COVID resulted in a number of companies, think like Slack, Peloton, other companies that were able to benefit from COVID containment measures. They got significantly overvalued. Also, a lot of tech stocks that had high growth multiples got significantly overvalued. Growth has been outperforming value for nearly 7 years. And so a lot of growth stocks were overvalued coming into this period of time. So when we look at that, it's very similar to the end of the blow-off phase in 1999 headed into 2000. The next comparison is the dollar. The dollar peaked in the late 90s as U.S. raised interest rates and as the U.S. economy was doing very well. So we're seeing a similar peaking in our view in the dollar today. The next component that is similar is remember that in that period of time, initially those higher interest rates and concerns about valuation hit growth stocks first. And so the broader markets corrected, but we didn't see a recession in 2000. Recession didn't hit until 2001. And so we think that's also similar to today. We're seeing a significant correction in stocks, and that's largely due to interest rates. And so I'm going to explain for a moment about why interest rates are so impactful for stock prices. So as the Fed began to raise interest rates, we need to understand that basically when we're buying a company or when we're valuing a company in the market, we're looking at the future cash flows from that company. And that's really what we're buying. We're buying a series of future cash flows. We discount those cash flows back to present at some interest rate, the prevailing interest rate. So when interest rates are very low, markets can support a higher price to earnings multiple. So think for just a moment, if I have $1 of earnings and interest rates are low, perhaps I can support a multiple of 25. That would say that my $1 of earnings is worth $25 today, my $1 of future earnings. On the other hand, if interest rates go up significantly, then I have to discount that multiple. And so maybe now I can only support a multiple of 20. So that means that my $1 of future earnings is only worth $20 today. So that is very, very important to understand, because what's happened over the last 9 months is interest rates have gone up from basically zero to almost 4%. And actually in some areas of the market, they are at 4 and moving above 4. And so that shift in interest rates has caused a contraction in the market multiple, meaning that companies have gotten cheaper simply because as investors look at those future earnings, they say, hey, they're worth less today because I can earn more on my cash. And so the discounting function has changed the valuation of markets. That's incredibly important because what we've seen to this point in Cornerstone's view is mostly an adjustment to the multiple that we're paying for future earnings. It's not a reflection of a coming recession. It's actually just an adjustment to market multiples. Now, that's critically important on the stock side. It's also critically important to understand on the bond side, because in the short term, remember that as interest rates go up, bond prices go down. But bonds are different than stocks. As long as the company doesn't default, the company has to pay back the debt that they owe. They have to pay back those bonds. Also, bonds are constantly moving towards maturity. So if you're down on a bond, and that's what makes this market so different from past markets, is that bond holders are down more than they've been any time in the last 100 years. We have yet to see in 100 years of American history a bond market that has seen this kind of negative price action. We got close in the early 1980s, but we never saw price declines of this magnitude. And so for many of you on this call, this feels worse because your conservative portfolios are down more because of that adjustment in short-term pricing. But here's the silver lining to that. remember that all of those prices are moving back towards par value all the time. So you're actually gaining back any losses as you hold those bonds. Now, here's the other factor that's really important to understand, is that your interest rate doesn't change. The reason that those bonds change in price is to make that current yield equivalent to a new issue bond. So all of the bond managers that we're using know all of these factors, and they are using this opportunity to not only purchase new bonds that have higher interest rates, thereby bringing their yield up, but they're also holding on to bonds that are moving, we call it rolling down the curve. So as interest rates level out, the overall yield on our portfolios has massively increased. And this is a really, really important factor, because for forward-looking returns, we have gone from what we would have said a year ago was an expected return on our intermediate term bond portfolios of 2.5% to 3% to a forward-looking return of over 5%. And so for those of you who have 30, 40, 50, 60%, maybe even 80% of your portfolio in bonds, this is a key component, because that's going to begin to work in your favor, bringing back the losses of 2022 and resulting in significant gains likely in 2023, 2024, and 2025. So we expect the next 3 years to be significantly positive on the bond side. Now, as I said, markets have adjusted to this point largely based on multiples. We think that there could still be another leg down as markets try to adjust for a possible recession. So the bad news that I have for you on the market side is we've seen a lot of volatility. We're in the midst of a positive bounce following a really tough third quarter, but we don't think that bounce is sustainable. We think that we may see a retracement either late this year or early next year as markets brace for additional Fed rate hikes and a possible recession. So again, going back to our analogy of 2000 to 2002, we saw a couple years there where markets were very volatile and negative. We think that's going to be similar this time, that we are going to have negative markets for all of 2022. We probably won't end close to our lows, but we will have a negative total return for 2022. And we actually expect a challenging environment in 2023. We could see a rally late in the year that's actually the start of a new bull market. Now, what is Cornerstone doing about these things, and why does this all matter for you other than from the fact that you're down? There's a couple things that are important. One, you do not need to do anything or panic at the moment, because Cornerstone is fully engaged inside these portfolios working on your behalf. So what are some of the things that we are doing and have done? The first thing is that on that bond side, we shortened duration coming into this year. Shortening duration means that we've experienced less decline than the broader bond market, and we've seen quicker increases in our yield. So that's been very positive. So our portfolios are down much less than broader bond indexes, and the yield has quickly bounced. And so at this point, most of our portfolios are generating a yield between 4 and 5% across the fixed income complex. So that's going to help you significantly as we roll into next year. So most of the price action that you've seen, while negative, is not permanent and will actually right itself over the next 12 to 18 months. So that's point number one. Point number two is that on the equity side, we have tilted towards value. Many of you have heard us talk about that. And that value tilt has resulted in, again, significant outperformance relative to growth-oriented stocks. So if you've been following growth indices, they're down 35% or so. Of course, after this week, they're only down 29 or so. But generally speaking, the low point for most growth indices has been in the 30 to 35% range, whereas value has only been down 10 to 20. So again, that's not a great consolation, but all of those things help protect you in a diversified format. So the portfolios are tilted towards value to take advantage of the defensive characteristics of value, and also the fact that we expect value to outperform for a significant period of time. The other element of having more value stocks in the portfolio is the yield component. Typically, value stocks produce more current income. So again, if we look at the portfolios as a whole, we're getting more yield from our bonds, we're getting more static yield from our stocks. And so together, that's helping put a floor, if you will, under the portfolios. Now, as we think about where we're going and what else we can do, there's a couple things to talk about there. So more recently, Cornerstone has moved more of our assets, not out of stocks, but into more defensive manager exposures. So this has helped, again, from a protection standpoint and a forward-looking standpoint, as those managers have continued to outperform their more aggressive peers. So that's a defensive move. As we move towards the end of the year and move into next year, we actually envision the fact that there will be additional opportunities to rebalance the other way. And so that's the other piece that we have to remember during times of duress like this. And that is that counter-cyclical rebalancing is the best friend of the investor. It's the opportunity we have to buy while things are down. And so that can be really difficult to do. But we have a structure in place that allows us to consistently review all of our portfolios and look for opportunities to rebalance. So as we move into the end of the year, we're actually going to be allowing cash to creep up in the portfolios from those dividends and interest that we're receiving. That will actually put a little buffer underneath portfolios and give us the opportunity next year to rebalance more fully into these opportunistic areas, potentially international as the dollar peaks, but also into lower valued growth companies that have been sold off. So we see opportunities coming from that. The last thing that I wanted to mention on that portfolio action side is that the rising cash component also provides a liquidity buffer. And so for many of you, this can feel very unstable and scary when we see markets move around like this and see significant declines. But I would remind you that all of you that work with Cornerstone have investment policies or plans for your portfolio in place that take into account the liquidity demands that you have. And so we always have cash and short duration securities so that we can utilize those securities in times like this and not be forced to sell at fire sale prices. So we have portfolio liquidity positions built into your portfolio. And so we're not panicking in this type of event. Now, let me close with just a couple of final thoughts to wrap this all up. So as I said, at the moment, the U.S. is still in an expansionary phase from an economic perspective. However, the market, both stock and bond, is fully in a bear market. We don't expect that to change in the immediate future. However, as we roll into 2023, we do expect the bond market to quickly improve. And we would be surprised, honestly, if we don't see significant positive returns from bonds in 2023. On the stock side, we think there's more pain to come. And it's going to remain volatile for the next 6 to 9 months in our view. It could even persist a bit longer than that. So we need to be prepared for additional volatility. On the economic side, at this point, as Cornerstone looks on a forward-looking basis, we think that the economy most likely will experience a recession, although we think it's going to be a shallow recession like 2001 in 2023. Unemployment is likely to move back up from 3.5% towards 5%, could even get as high as 6%. That's what it hit in 2001. But again, we don't expect it to be a significantly painful recession like 2008, where unemployment got above 10%. So the good news from that thought process is that ultimately all of those factors we think will lead to a gradual decline in inflation. And so currently, market expectations for inflation looking 3 to 5 years out are back down in the 2.5% range. And so at this point, we think that as the Fed tightens rates, that's going to help gradually bring down inflation. We expect further smoothing in supply chains from a logistics standpoint, and then significant improvement in supply chains from a manufacturing standpoint and weakening demand brought about by the Fed. So all of those factors we think will actually dampen inflation out 12, 18, 24, 36 months. So while we're concerned in the short term that inflation's not going away immediately, we do see a significant path of reduction over the next couple of years. So we don't think we need to be overly alarmed about a long-term inflationary or stagflationary environment. So we're positioning portfolios accordingly to kind of deal with what our expectations are. Now, let me close with a couple of questions. As I said, just some rapid fire questions that people have been asking, and I want to make sure I address them. So first one of those is, should we make significant changes to our allocation? The answer to that question is generally no. It's generally not good to panic and make massive adjustments to your asset allocation when things are down or very volatile. So we've taken into account risk tolerance. We've taken into account many different historical parameters. And as you know, our overall system is designed to weather significant declines in the market. But it does require patience. And so we're not trying to time this market. We are trying to tactically take advantage of opportunities. So you don't need to panic and make massive adjustments now. If you are concerned, please feel free to reach out to us. We're happy to have a more detailed conversation about your specific situation. Second question that we get a lot of, and I addressed it briefly, was what is Cornerstone doing inside portfolios? So I mentioned the shortening of duration. I mentioned the fact that we have a defensive value tilt that we are maintaining in portfolios. I mentioned the fact that over the course of the fourth quarter, we'll be allowing cash to build in portfolios from that rising yield and distributions that we experienced during the fourth quarter. And then finally, we're taking advantage of growing interest rates to better deploy cash in short-term bonds at those higher rates. The last thing that we're looking at from a portfolio perspective is the opportunity brought about by a very strong dollar. So one of the things we need to remember is that when we have a strong dollar, that makes foreign investing for U.S. investors less attractive. So we have been and always are underweight international relative to domestic in broader indices. That's a typical structural thing that Cornerstone puts inside our portfolios. It's built in by policy. However, we see the opportunity coming. I don't know exactly if it'll be first quarter of 2023 or maybe second quarter of 2023 for additional tilts into the international markets, particularly in emerging markets. They've been hit very hard, and as the dollar begins to decline, it will act as a tailwind for international assets. So that would be the fourth thing that we're doing inside portfolios, is evaluating opportunistically chances to invest very cheaply overseas. That also ties into that third question, about opportunities. So that's the biggest opportunity we see is the transition in U.S. dollars. We do see one other opportunity that we're evaluating very closely, and that's the opportunity brought about in energy. So most managers have underweighted energy in recent years due to the prevalence of demand for green energy and green solutions. And so what that's done is effectively it's underutilized traditional energy, and it's basically underfunded traditional energy. And so traditional energy has lost ground inside most clients' portfolios, not because Cornerstone specifically avoided energy, in fact, quite the contrary, but rather because managers have avoided that space. And so we're evaluating whether we would like to add some more dedicated exposure, because we do see here a 2 to 5 year trend where energy may significantly outperform as people realize that we're going to be reliant on traditional fossil fuels for some time to come as we make this transition into green energy. And then finally, another question we get is, what about distributions? Well, for those of you out there that are institutional clients, charitable trust distributions will be negatively impacted for 2023. Portfolios will be down. So if you have a standard payout trust, we're working on some communication that you can provide to your donors that will alert them to the fact that their 2023 distributions are likely to be significantly lower than their 2022 distributions. The good news on that front is that most of those donors have seen significant expansion in their distributions over the last 5 years. And so this setback should not be too dramatic. On the net income trust side, we actually think you'll actually see no change in distributions and may actually pick up a bit on the net income trust. So that's actually a positive. For those of you who are individuals who work with us and are wondering about distributions, remember, as I said, we've generally built in plenty of liquidity to your portfolios to cover for any liquidity issues you might have. Again, if you're concerned about that, please reach out to us. We're happy to talk through it with you. Thanks so much for your time and attention today. It's been a pleasure to meet with all of you. As we said, this is a recorded call, so you're welcome to ask for a copy that you can listen into later, and we'll send you a link. Thanks so much. Take care.
Thank you, Bryan. Thank you, Brian.